Hello everyone, good morning. My voice is audible and can you see my presentation? Okay, 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 no problem. We will wait for 2 to 3 minutes. Some students are joining in between and then we will start. Just pin on presentation, Vikram's on presentation. It will find, you will find it in the list and pin on it so that you can see the presentation continuously. Okay, we will start now. So in the last lecture, we have discussed about the investment decision and we will come to know that the meaning of investment decision and for which act we have to consider the investment. Okay, so investment means purchase of things or assets for the profit. Okay, for the profit, and one can say that if the time period in which the firm will get benefit more than 1 year, uh, then such a purchase is called as an investment. Okay, and the money spent on this act is called as a expenditure. The money spent on this act is nothing but a expenditure. Then we have seen the capital investment. So capital investment is one kind of a real asset for the industry. So we can consider any kind of a shape which is a real one and it is an asset for the industry. So such an investment is called as a capital investment. Okay, so we can consider the buildings, plants, then machineries, uh, uh, plant machineries, then raw material. So this consider this purchase or this particular act of purchase of these things or similar things will be considered as a capital investment. Now this particular capital budgeting and the investment decisions are having the same meaning in the business world, or we can say that financial management. Okay, they we cannot differ this particular two words, that is nothing but investment decision and capital investment. Okay, so then we have seen need of investment. Okay, so investment is required to survive the industry in the market. Okay, to cope up with the market demand, uh, to uh, to uh, to increase the growth of any firm and uh, become an leader in that particular sector. Okay, to become an leader, uh, to become a leader in that particular sector, this particular investment is required. Okay, to capture the shares of a market. Okay, proper shares of a market, the investment is required, and to cope up with the current scenario, to cope up, to increase the profit and reduce the manufacturing cost, the investment is required for the industries. Okay. Now we have seen the categories of investment decisions also. So these categories are nothing but the inventory investment. Okay, obviously inventory is one kind of investment because the fluctuation of demand in the market that can be accommodated by using by maintaining the proper inventory level or by scheduling the proper inventory, we can accommodate that market demand. And this inventory is also called as one kind of investment because we know that to produce maximum number of goods we require raw material. So carrying the inventory of raw material, it's one kind of investment. And holding the finished goods or holding the stock of finished goods after production, we have to store that particular products to cope up with the market situation and to adjust the market demand. Okay, so for that purpose, the finished good stock is required. Okay, so this finished good stock is one kind of investment for the industry. Okay, then we have seen the strategic investment expenditure. So to strengthen the market, okay, market situation for any industry, the strategic investment expenditure helpful to that particular industry. Then modernization investment. We have seen that some of the technologies in the industries are wash out, or we can say that outdated from the current scenario. And in that case, to increase the profit of the company need to modernize the technologies of industry. So the investment to purchase the new technologies, that particular investment will be considered as modernization investment. Then we have seen the expansion investment on a new business. The company want to start, in case the company want to start the new type of a business. Okay, so that will be, or the company want to earn the extra money by starting the new stream of a business. So in that case, that particular investment will be considered as an expansion investment on a new business. Then replacement investment. Okay, so for some of the machines of company, some of the machines in the firm or in the industry are worn out due to long run. Okay, due to long run, and that need to replace. Okay, as the maintenance charges are getting get increased because of long run. Okay, and we will not get the required efficiency from that particular machine. So in that case, company decide to replace that particular machine, and to replace the machines or the facilities, whatever the investment required, that is called as a replacement investment. Then expansion investment. Okay, so expansion investment to increase the capacity of plant, expansion is required. Okay, and this particular expansion comes, the investment on this expansion is called as a expansion investment. Okay, then today we are going to see the various evaluation criteria for this particular investment decisions. So these criteria will helpful to consider the investment, when how to do the investment or not. Okay, in a particular thing, when how to, or industry how to do the investment or not in that particular sector. So the real meaning of this particular capital investment analysis is to computing and comparing the benefits. Okay, so cash inflow, that is nothing but obtainable over a period of time, with cost, that is cost outflow. Okay, so comparison should be done in the evaluation criteria. So comparison is nothing but what, whether it will provide the proper benefits, or we can say that it is feasible to get the profit from that particular investment. That will come to know by using the evaluation criteria, by using evaluation criteria. So this particular evaluation criteria based on the cash inflow and the cash outflow. Okay, so in the company, the cash inflow, that is nothing but someone purchase any product of that particular company, then that will be the cash inflow for the company. And uh, the the cost which the company spend on producing that particular goods, that is nothing but the cost outflow. That is nothing but the cost outflow. So to evaluate this particular investment decisions, there are some criteria that criteria are mentioned over here. So commonly and important criteria are mentioned over here. The first one is a payback period. Second one is the average return on investment. Third one is a net present value. Fourth one is the internal rate of return. Fifth one is the benefit cost ratio. Sixth one is capital rationing, and seventh one is the profitability index. Okay, so please note down this evaluation criteria, the first point of today's lecture, evaluation criteria, and please note down this all the criteria. Okay, so yeah, in this lecture we will see the payback period and average return on investment, these two criteria. Okay, so please note down. If you have any doubt, any question, you can ask. So one by one we will see. Evaluation criteria for the investment decision. Over, everyone. So shall we move ahead? Shall we move ahead? Please note down these criteria. Okay. So the first one is nothing but payback period. Okay. So payback period itself define that how much time is required to get the return from that particular project or that particular investment. Okay. So it is the length of time required to recover the investment made on the project, which is recovered by the net return from the project, which is recovered by the net return from the project. Getting? So payback period. So consider that if you have invested 1 lakh rupees on any project, or we can say that you have own one shop in one of the building, and you have investment near about 10 lakh rupees to own that particular shop. Okay, so how much years required to take out that particular investment from the net profit? Okay, so how much years it will require to catch up the return from that particular investment? Okay, so consider that it will each year you will get a profit of near about 2 lakh. Okay, so how much year it will require to recover that particular investment? Okay, so that is nothing but what? The payback period. So if the cash inflow are same in each year, the payback period is expressed as, okay, we are considering that the cash inflow, that is nothing but profit for the company, it's constant for every year. Okay, if you are considering the profit for the company is constant for every year, okay, then in that case the payback period can be uh, calculated on the basis of this particular formula. The formula is mentioned over here, that is nothing but n is equal to I divided by b. Okay, n is equal to I divided by b. So where this n is the payback period in years. Okay, n is the payback period in years. Then I is the initial investment. Okay, I is the initial investment, and b is the net return in bracket benefits per annum. Okay, net return in bracket benefits per annum. Okay, so now here we are considering I is nothing but initial investment. Okay, whatever we are investing to purchase that particular asset, or to start any kind of a business. Okay, that will be nothing but what? The initial investment. Then the return per annum. Okay, so this particular return is nothing but what? After calculating your uh, working capital, that is nothing but what? If there are labors, machines, okay, electricity bills, okay, water bills, everything, by considering all this particular expenditure and whatever you earn throughout that particular year. Okay, so that will be subtracted, and the net income is, sorry. So, whatever the working capital, that is nothing but what? You are investing to carry out or to produce something. Okay, daily you are investing some amount of money to carry out the production from that particular machine, or from that particular plant. Okay, and by subtracting that particular working capital, whatever the benefits you are getting, so that is nothing but what? B, that is nothing but what? Return per annum. Return per annum, by subtracting the capital, working capital, whatever the benefits you are getting. So shorter the payback period, the more desirable is the project. Okay, so we can say that if your money is recovered within a less time from that particular project, then that particular project is more beneficiary, and that will come, or it will takes first, uh, it will take on a first priority for the company. Okay, so shorter the payback period, more desirable is the project. Okay, then what are the strengths and weaknesses of this particular payback period? Okay, so we have seen that there is simple formula to calculate this particular payback period, and this is nothing but n is equal to I divided by b. I divided by b. So the calculations are very simple. Okay, and it is very easy to understand also. So we can say that these are the strengths of this particular evaluation card. Is there, Rohit asked one question. Is there any general value for payback period? I mean, is that period we should get profit which is at least equal to initial investment? Okay, payback period is providing the number of years. That is the initial question arises for any investment. Okay, that is the initial question. So if I get some kind of a profit, I assume that I will get one value by doing my all the calculations. I get that, yes, this much profit I will get per year. Okay, so that will be the rough value. The profit will vary, but in initial condition we can assume that that particular profit is constant throughout the years. Okay, on some assumption. Then this particular payback period gives how much years you will require to recover that particular investment. Okay, recover that particular investment. Now it's depends on further factors. Okay, whether you have to go for that particular investment or not. You have to go for that particular investment or not. So the investor has to decide that whether I have to go for that investment or not. So sometimes the companies or the investor decide that, yes, if I recover this particular profit in a 3 years, okay, then I will invest in that particular project. Or we can say that if I recover this particular investment in a 10 years, then I will invest in that particular project or in that particular share market. So in this manner, one can say that there is no such a norm that if the periods are lesser than 5 years, then you have to invest. No, no. There is no such a criteria for the investment. Okay, so the bigger the investment, more years are required to get the profit from that particular project. So you take the one example, Rohit. Mark Zuckerberg invested on Facebook, or the space owner of a space company, SpaceX company. I'm not remember now. I'm not taking that particular. Someone insist me the name of that particular person. So the owner of
Elon Musk.
who?
Elon Musk.
Elon Musk. So the Musk has invested lot of money on one of the project. That is nothing. He want to make that particular space agency on a private as a private industry. Okay, so so many space industries are there as a private sector, but more investment is required to start such a project. Okay, and the more number of years will require to recover that particular money. You take the example of Amazon company. So Amazon company started near about 1995. Okay, and they have marked their first profit near about 2012. Okay, near about 2012. I think near about 2012. It may be more than 2000. I think 2015. So more investment, more payback period will be required to carry out that investment or to recover that investment from the market. Okay, so there is no such a criteria that the payback period will be this much and then you have to invest. Okay, it's just a trial and error method, and those are having sufficient knowledge in that particular sector for that particular project, then only one have to invest in that particular project. Okay, so uh, and for that purpose, the cash value of money plays very important role. Okay, for that purpose, the cash value of money plays very important role. So upcoming lecture I will tell you what is meant by cash value of money. Okay, so getting my point. uh, yes, Elon Musk, Avinash Mankalas. Okay, so Rohit, getting okay. So we come to know that this is very simple to calculate and easy to understand also. Okay, and weaknesses of this uh, particular method is nothing but the answer in years, not in dollars. Okay, or not in cash, or not in form of a money. Okay, we will get the number of years, we will not get the cash. And disregards the cash flow after the paybacks. Means what? We'll get the number of years through that particular methodology, and we will not have after calculation, will not come to know that what will happen after that particular number of years, what will happen after that particular number of years from that particular methodology. So it will give only one uh, figure, that is nothing but it is in the form of years and nothing else. Okay, so this much years are required to recover your investment. Okay, then uh, does not account for the time value of money. Now it is very important. Please understand the meaning of money. Okay, time value of money. Okay, so if you want to take a loan from bank, okay, so bank will apply the interest on that particular money. Bank will apply the interest on that particular money. Means what? And you want to pay back that particular money to bank, then bank will ask to pay the rate of interest on that particular money. Okay, to pay the rate of interest on that particular money. Now if you are investing on some of the projects, okay, consider that your investment is 1 lakh rupees. Okay, so after 5 years, okay, according to the bank interest or according to the normal interest available in the market, the money value after 5 years or after 6 years, it will be doubled. Okay, so that means what? 1 lakh money value will becomes a 2 lakh money value. Okay, getting what is meant by money value, time value of a money, everyone? If you want to take a loan from a bank, then bank will apply the interest, and when you want to pay back that particular amount to the bank, at that time you need to pay the interest on that particular money. Okay, say that after 1 year you need to pay the 1,10,000 rupees. Okay, after 2 years you have to pay 1,25,000 rupees, 1,30,000 rupees. So the value of 1 lakh will not be the same after two years. Value of the money will not same after 2 years, it will be changed. Okay, so एका छोट्या शब्दात सांगायचं म्हणलं तर पैसा पैसा कमवतो. ओके, पैसा पैसा कमवतो, म्हणजे पैशाची व्हॅल्यू कधीही सारखी राहत नाही, ती नेहमी चेंज होत जाते. सो दॅट इज नथिंग बट व्हॉट? द टाइम व्हॅल्यू ऑफ मनी. ओके, सो यू कम्पेअर in this manner to understand the time value of money. Okay, getting everyone what is meant by time value of money? Everyone, please mention in the chat box whether you are getting what is meant by time value of money, or is there any question regarding this? Okay, everyone, you have any question, please you can ask, or you can mention in the chat box. Okay, so I will move ahead. Now here I have mentioned the same problem or example, simple example I have mentioned over here. Okay, so a company invested 10 lakh dollars on a project, and net return from the project is 2,50,000 per year. Find out the payback period. Find out the payback period. Okay, so nor one company is there. Take consider that XYZ company, and that particular company has investment 10 lakh dollars on one of the project, and the net income. Okay, so after subtracting the capital working capital from the profit, so the net income or net return from that particular project is 2,50,000 dollars per year. Then what will be the payback period? So we have formula, that is nothing but n is equal to I divided by b. n is equal to, we will get the I value, that is the initial investment value is 10 lakh dollar, and b is nothing but what? The net return from that particular project, b value is 2,50,000 $50,000. Therefore we will get the number of years, that is nothing but n is equal to 4 years. So 4 years are required to recover that particular investment from that particular project. Okay, so n is equal to 4 years. Getting everyone how to calculate the payback period, how to calculate the payback period, and advantages and disadvantages of that particular project. Okay, so please note down some of the points from this particular payback period. Okay, payback period. If you have any question, any doubt, you can ask in between, no problem. Note down the points related to payback period. Don't sit ideal. Okay. So it will be useful to understand when you study the same things afterward, and it will go through your hands also. Okay. It will be one kind of practice. If you finished your write up from this slide, please mention in the chat box. Then we can move to the next slide. Okay. Advantages and disadvantages of payback period. Have you finished from this slide? Whenever when you are finished from this slide, please mention in the chat box so that we will move ahead. Shall we move ahead, or you require some more time for the write-up purpose? Ganesh, have you written? So Ganesh is saying yes. Okay, then we will move ahead to next slide. Okay. So next, write down the strength and weaknesses of payback period. Strength and weaknesses of payback period. Or shall we move ahead to next slide? Okay. So note down the simple problem also. So it will easy to understand the concept. Have you noted this particular problem? Example. Okay. So next method or next criteria is average return on investment. Okay, average return on investment. So this is also called as the return on investment. Okay, so another term. Okay, please mute yourself. Anybody unmuted? Can you get my voice, everyone? Okay. So the next criteria. Okay. So next criteria is average return on investment. Okay. So this terminology is also called as a return on investment. Okay. And the short form for this particular terminology is ROI, capital ROI. So the average return on investment is defined as a ratio of net average income from the project to the investment made in that particular project. Okay. So definition is important. Ratio of net average income. Okay. So net average income means what? Whatever the income you are getting throughout the year. Okay. 1 year you are getting the 2,50,000 rupees. Another year also you are getting the 2,50,000 rupees. The net income will be 2,50,000 rupees. So the ratio of net average income from the project. Okay. and to the investment made in that particular project. Okay, so your investment is at the initial level only, or your investment is divided in some of the years. Okay, that is nothing but what, first year your investment this much amount, second year investment you are uh, uh, something small amount that in the first year. So the average we can say that the it is the ratio. One can say that the average return on investment is the ratio of your income, average income for that particular period of years, and the investment made in that particular project. So net income is what? The net income is defined as the difference between the net cash inflow and cash outflow. This is also called accounting rate of return. Okay, so always we are calculating the profit or loss on the basis of a cash inflow and cash outflow. किती रुपये किती कमवलंय कंपनीनं आणि किती घालवलंय कंपनीनं. So that is nothing but what? Cash inflow and cash outflow. Whenever the cash inflow is greater than the cash outflow, then we can say that the company is in the profit, or that particular firm is in the profit. If the cash outflow is greater than the cash inflow, then we can say that the company or that particular firm is in the loss. Okay, so it is also called as a accounting rate of return. Accounting rate of return. Okay, getting everyone what is meant by net income? Okay, so for that particular year, the whatever the expenditure that is subtracted from the earning. Okay, expenditures are subtracted from the earning, and whatever value we are getting, that particular value is nothing but what? Net income. That particular value is nothing but what? The net income. Okay, so average rate of return can be expressed. There is one formula for the average rate of return. Actually, one no, there are two formulas for the average rate of return. So first one is nothing but, we can say that it is the wording formula. Average rate of return is equal to profit after tax, that is called as a PAT. Okay, profit means what? For every earning, or we can say that for the earning of a company, there will be a tax. That company need to pay the tax. Okay, so tax should be subtracted from the profit. Okay, so that we can say that there is a GST in India. 18% GST is there. In that also, if you want to segregate that GST, the CGST for the states, and HGST for the state level, and CGST for the central level. So such a taxes are there. Then educational taxes also there. Then some of the we can say that other types of the taxes, if it is available or it is implemented for that particular sector. Okay, if your company is in MIDC, then there are different kinds of taxes that also included in that particular that also subtracted from the earning. And whatever the profit figure we are getting, that is nothing but what? Profit after tax. It is called as PAT also, divided by book value of investment. Okay, divided by book value of investment. So sometimes it will be the depreciation value also. Okay, and sometimes it will be the initial value also. Sometimes it will be the initial value also. And if you are having n number of years for the investment. Okay, so you have started one project and you are investing in that particular project for 5 years and 6 years. Okay, so in that case, the average book value we have to calculate. Okay, so if you have to if you are considering the average rate of return for 1 year only. Okay, if you are considering the average rate of return for 1 year only, in that case, this particular formula, that is nothing but profit after tax divided by book value of investment, is useful. Okay, and if you are investing and you are earning the profit for number of years. Okay, in that case, we have to consider this particular formula. That is nothing but the average rate of return on teeth year. Okay, average rate of return for teeth year is equal to summation of P suffix T. That is nothing but profit after tax for the number of years divided by n minus 1. Okay, where this n is nothing but what, number of years. Okay, n minus 1 whole divided by summation of bvt divided by n. Okay, so bvt is nothing but what, book value for t periods. Okay, book value for the t period divided by n, divided by n. So if you are calculating for 1 year only, in that case the first formula is very much useful. That is nothing but profit after tax divided by book value of investment. And if you are calculating for number of years, okay, consider 3 years, 4 years, so n is equal to that much number of years. Okay, and profit over that particular years, we have to take the summation for that particular years. So consider that if for the first year you have on 1 lakh, for the second year you have on 1,50,000. So summation of all such a profits we have to consider. Okay, and here the book value. So the book value for any machine or any plant is changing for the years. Okay, it will not be constant. Okay, so if you are considering the book value difference differ for different years, then we have to consider the average of that particular book value. Okay, we have to consider the average of that particular book value. So here we can say that P suffix T is equal to profit after tax and B suffix VT is equal to book value of investment at Tth year. Book value of investment at Tth year. Okay, getting everyone? Now, what are the advantages of this particular method criteria? Okay, so once again, it is very simple to calculate without any complicated procedure. It is based on accounting information which is readily available. Okay, so accounting information means what, how much expenditure is there and how much earning is there. So that is nothing but what, accounting expenditure, and at the end we will get the profit or loss. Okay, at the end we will get the profit or loss. So it considers the benefit over the entire period of a project life. Okay, in case of a payback period, we have considered that. So payback period provides the number of years only, and it will not consider anything after that particular payback period. Okay, will not get any information after that particular payback period years. Okay, but this particular methodology uh, is applicable, or this particular methodology consider the benefits over the entire years of a project. How much year your project will run, that much years benefits will be undertaken over this particular uh, criteria. Okay, then what are the disadvantages of this particular criteria? It is based on account profit, not on net cash flow. Now here we have to understood what is meant by account profit and what is meant by net cash flow. Okay, so account profit is nothing but one kind of a statement. Okay, one kind of a statement. So if you are visiting to the bank, or if you have any account in any of the bank and you are getting the statement of that particular bank on your email. Okay, then every month, every at the end of every month you will get the statement. Okay, so that is nothing but what, how much money is debited from your account and how much money is credited in your account. Okay, so considering in the same manner, in the industry, the finance department is working on this particular sector, and in this particular stream, that is nothing but what, it account how much money comes inside the company and how much money goes outside the company. That is nothing but expenditure and income. Okay, debit and credit. So that will be accounted uh, by the accountants, or we can say that by the finance managers. Okay, so this particular methodology consider only account profit. Okay, so at the end of that particular periods we'll get the value only. Okay, that is nothing but what. So yes, the if you consider your investment is 1 lakh rupees and your income is 1,20,000 rupees. Okay, you have earned 1,20,000 rupees, so your profit will be 20,000 rupees. Okay, so that will come to know from the account statement. Okay, that will come to know from the account statement. It is called as a accounting profit. okay, and not on net cash flow. Now, what is meant by net cash flow? So now consider that we have installed one machine in our plant, or in your plant. You have one plant and you have installed one machine. Or consider that you have purchased one bike. Okay, you have purchased one bike, and it's cost near about 50,000 rupees. Okay, and you have used that particular bike for uh, 1 year, and you want to sell that particular bike. Okay, then the value of selling value will not be the same one. Okay, whatever the purchase value, it will be lesser than that particular selling value. Okay, uh, the selling value is less than the purchase value. Okay, so that is nothing but what, here we have to consider the depreciation cost. Okay, and that should be added in the account profit, or that should be added in the account statement. But whatever the account statements are there, it will not consider the depreciation values. Okay, it will consider in this particular net cash flow. It will consider in the net cash flow. Okay, so whatever machines we are using to produce that product, or to earn that particular profit, so the value of that machine also goes on decreasing. Okay, so that should be added in the expenditure. That should be added in the expenditure, but it will not added in the accounting profit. It will add in a net cash flow. It will add in a net cash flow. So this is nothing but what, the net cash flow consider all the charges. Okay, which will we can say that it will be the depreciation cost, or the charges on the profit. Charges on the profit. Okay, so the net cash flow calculate the actual cash flow for the company. Actual uh, cash flow for the company. Getting everyone? What is the difference for accounting profit and net cash flow? Accounting profit is just a statement. Okay, what is earned, and how much is earned, and how much is expended for that particular year, and we will get one value. That's it. That is nothing but accounting profit. Whereas net cash flow also consider the depreciation cost for the machines, also consider the charges on the profit. Okay, and whatever the value we are getting, that will be considered as a net cash flow. That will be considered as a net cash flow. Okay, here in this particular criteria, evaluation criteria, only accounting profit will be considered. Net cash flow is not considered. Then next one is does not take into account the time value of money, obviously. So time value of money is very important in this particular methodology also. The time value of money is not considered. So I have given what is meant by time value of money. You better understood now. So then average rate of return measure is internally little consistent. Okay, so average rate of return. Okay, we are considering that average of throughout the year. Okay, so we'll come to know that it is consistent one. Is what, uh, when you are taking the average. Okay, so it will uh, reduce, or we can say that it will not show the gaps. Okay, it will not show the gaps for what reason this particular rate of return we are getting. Okay, so it will not uh, understood from this particular methodology, so that we can say that it is little consistent. It is little consistent. Getting everyone? Now, to understand this, I have mentioned one problem over here. Okay, to understand this particular methodology, I have mentioned one problem over here. So we'll see this problem afterward. Please note down the points related to the average rate of return, and uh, meanwhile, I will take the attendance. Okay. If you have any question, any doubt, please ask. Once we will see the problem, then we'll understood what is meant by average rate of return. Okay. So rule number 1,
Yes, sir.
2,
Yes, sir.
3,
Yes, sir.
4, Absent 5. Absent 6. Absent 7.
Yes, sir.
8.
Yes, sir.
9. 10.
Yes, sir.
11.
Yes, sir.
12.
Yes, sir.
13.
Yes, sir.
14. 15.
Yes, sir.
16.
Yes, sir.
17.
Yes, sir.
18.
Yes, sir.
19. 20.
Yes, sir.
19 present. Okay. 20. 21.
Yes, sir. Yes,
22.
sir.
Okay, Omkar. 22. 23. 24.
Present, sir.
24 present. Okay. 25. 26.
Yes, sir.
27. 28. 29.
Yes, sir.
29 present. Okay. 30
Yes, sir.
present. Okay. 31. 32. 33.
Yes, sir.
33 present. Okay. 34.
Yes, sir.
Okay. 35.
Present.
36. 36. Absent. 37.
Yes, sir. 37.
Okay. 38.
Yes, sir.
38 present. Okay. 39. 40.
Yes, sir.
Okay. 41.
Yes, sir. Present.
42. 43. 44.
Yes, sir.
45. 46. 47.
Yes, sir. Present.
47. 48.
Yes, sir.
48 present. Dayanand, 48, no?
46, sir.
46. Okay. 48 absent. 47. 49. 50.
Yes, sir. Present.
Okay. 50. 51. 52. 53.
Yes, sir.
Ruturaj, 52. Okay.
Yes, sir.
Okay. Marked. 53. 54.
Yes, sir.
54 Pradeep, na?
Yes, sir.
Okay.
Yes, sir.
55.
Hmm.
Shubham, 55. Okay. 56.
Yes, sir.
Okay. 57.
Yes, sir.
58. 59.
Yes, sir.
59 we just. Okay. 60.
Yes, sir.
60. 61.
Present, sir.
62.
Present.
62 absent. Jeevan Raj, please mute yourself and please switch off your camera. 1 minute.
Yes,
Okay.
sir.
I will come to 1 minute. You please mute your camera and your voice. Okay.
Okay.
Okay. So 62. 63.
Present, sir. 63.
Okay. Mark. No problem. 65, 64.
64 present, sir.
Okay, 64 present. 65, 66.
Yes, sir.
66.
Hello,
Okay.
sir.
Yes, yes, mark that. 67,
Okay.
67, 68,
Yes, sir.
69, 70,
Yes, sir. 70.
71,
Present.
72, 73, 74, 75, 76, 77, 78, 79, 80,
Yes, sir.
80, it's your page. Okay. 81, 82. So Harshal 71 mark attendance, no problem. Uh, okay. Mahesh Shinde. Okay, okay. Roll number 4, mark. Roll number 23, Ajinkya Jadhav. Okay, mark. Roll number 57, mark, no problem. Vaibhav Rode 49, mark. Mahesh Shinde 61, mark. Uh, Jivan Raj Kodi. Okay, your roll number. I'll tell you 1 minute, Jivan Raj. Jivan Raj Kodi, your roll number is 77. Jivan Raj Kodi, getting my voice?
Yes, sir. Yes.
Okay, okay. 77. Okay. Roll number 10. Okay, marked presentee 71. Marked 75. 75 mark. 69. Okay, marked 69. 18. Marked presentee 35. Mark presentee 80. Okay, no problem. We'll stop here.